Welcome to Business Model Hackers. This is a show where we unravel the complexities of business strategy and management tools alongside Sam Schreim. Now, Sam himself brings a wealth of experience to having advised everyone. And I'm talking to everyone from Fortune 500 companies all the way to startups, even governments and nonprofits, all in a strategic or consulting role. Now, with that said, we're going to be diving into some really interesting things today, and I can't wait to get into it. Sam, how you doing today? Let's check in.
Good. How are you today?
Doing good, feeling good. Personally excited about this episode, which is probably not the reaction most people have to hearing the accounting equation, but I believe is such an essential to the workflow of anyone doing anything worth doing that it's something we have to get into, especially on Business Model Hackers. So with that said, if you could, I think we can open it up with my opening question. What is the accounting equation? And if you could make it in simple terms, where we could explain the significance of each of the components of the accounting equation to someone who is new to accounting in general.
Yeah, this is not intended to be a course in accounting, right? And if you're an accountant, by the way, you will still benefit. If you know the accounting equation, you still benefit from this episode. So I'm not going to get into the nitty-gritty detail of accounting in here, but I think we're going to discuss the general concepts. The equation is very simple and everybody knows it, I think. It captures the relationship between a company's assets and its liabilities and the equity ownership. In a simple equation, assets equals liabilities plus equity. That's in the simplest terms. Some examples of key types of assets include like cash, inventory, building, equipment. Liabilities represent financial obligations like loans, accounts payable, debt. And the equity represent the net ownership interest, right, held in the company by its shareholders. This equation frames how every financial transaction and data point influences the total financial position in the company. When a transaction occurs, accounting ensures the change in value across one side of the equation is offset according to what they call double entry bookkeeping convention. Accounting teams analyze core assets and liabilities trends for capital structure optimization. So I don't want to get too technical, but I think what is important about this is that the fundamentals of a company's financials are captured here, right? Of the company's health, if you want. Without this equation, the financial statements, if you want, you wouldn't know how a company is performing.
Now, could you start maybe by sharing some kind of story about how the accounting equation plays a pivotal role in business?
Let's say you have an app. This app is about learning languages. You built the app and you poured your heart and soul into developing this groundbreaking language learning app. You knew the app had potential. Securing funding was an uphill battle. Investors bombarded you with questions. How much capital do you need? What's your projected revenue? To do that, you probably need an accountant if you haven't learned. And I think I'm bringing this example for a reason, which I'll get into later. So you bring in the accountant, which looks at it. Suddenly, that accountant explains to you that the assets are the app. Your laptop and a small amount of cash, those are basically assets of your company. And your liabilities, a few outstanding bills, let's say. And the missing piece is actually your owner's equity, which is represented based on what you have poured into the app. So now you are at a better position to explain it to potential investor. I'm not talking Silicon Valley investors. At this level, you're probably talking to your family. You need the level where you can explain it to friends and family and explain that this is what you've put in, this is what the assets and the kind of money you put into it. This basic concept here, it's a very basic business, which is an app that you're trying to build and has potential. I hope this kind of explains the importance of how the accounting equation can be used to kind of explain to people the value or the amount of money you need, because now you have kind of a view of how much money you can set up. Now that you understand these concepts, you can actually move into what we call finance. Accounting is kind of the basis that you use for finance, and in finance is what you need to learn. But without the accounting knowledge and the accounting equation knowledge, let's say, you cannot really move into the field of finance that you as an entrepreneur require to know, because everything that you do as an entrepreneur requires finance. You require cash, you need to go fundraising. So you need to understand those principles. If you don't understand those basic principles, you can't get anywhere, even with a simple app. That's the idea of this metaphor.
Is there an example you can share where a business decision directly demonstrated the importance of maintaining that balance in the accounting equation?
numerous, but I don't want to bore you with details. Let's say simple stuff like financial statement preparation. So the accounting equation forms the foundation of preparing the company's balance sheet. I mean, financial statement consists of three things: the balance sheet, the cash flow statement, and the P&L. Without that accounting equation, it's kind of the nucleus of forming that. Then you have budgeting, which we mentioned an example on the app. On the business level, it's far more complex than that. Tracking business performance. You want to look at sales, you want to look at accounts payable, your health, your cash flow health, investment decisions, loan applications. I mean, I don't think any bank would look at a loan application without having the sound financial statements ready. Risk management, operational decision making, not to mention mergers and acquisitions. So these are just some examples of where it's actually used.
Would you be able to put this into an analogy or a metaphor to just solidify this concept of accounting equation for the listener?
I think one good metaphor is, let's look at it as a recipe for a balanced diet. The diet is, let's say, your company's health. The assets are the nutrients you put into your body, like protein, carbohydrates, fats. These nutrients are essential for energy and growth, just like assets are vital for a company's operation and expansion. Liabilities, on the other hand, are like the calories you need to consume wisely. Just as consuming too many calories without a plan can lead to health problems, and taking too many liabilities without strategy can lead to financial difficult. Like a balanced diet requires some intake of calories for energy. Companies need liability like loans or accounts payable to fuel the growth and investments. The equity is like your stored energy or reserves. They build up over time through exercise, good nutrition. Business equity is the owner's stake, the internal funds available to the company that have accumulated through profits and investments. The financial, if you want, financial reserves that support the company during tough times. So to maintain a healthy company, it's just like keeping a balanced diet. Okay, you need to ensure that nutrients, assets are adequately supported by a mix of calories, liabilities, and stored energy, which is equity. I hope that explains it a little bit.
Yeah, and I was wondering if there was ever a situation you encountered, whether you can think of where a large corporation took advantage of the accounting equation.
The accounting equation itself isn't directly used, right, to take advantage of, but large corporations can, because they have, multiple subsidiaries globally, etc., they can manipulate, if you want, elements within the equation to potentially maybe reduce taxes or tax burden. Example of that is transfer pricing. Large corporations with subsidiaries all over the world, they can manipulate prices for which, for example, they overload price for a specific product that they sell to another subsidiary. So by doing this kind of inflation of cost of goods sold, they can load up the cost or have higher costs, high tax countries, lower costs in low tax countries. And this way they shift their profits from high tax places to low tax places. So that's one way they could do that. And then, for example, in depreciation or sometimes in intangible, what we call intangible assets, they increase these. That leads kind of to, for example, research, R&D, research and development, patents, trademarks. Those appear greater than they are. Depreciation, they can have accelerated depreciation. These are things that large corporations use to, let's say, save on taxes. The accounting equation itself isn't directly used. Manipulating elements within it to be part of a larger, let's say, strategy, tax strategy, is useful for corporations. But it's also crucial to remember that ethical and responsible tax practices are essential. For example, I don't know if you know this, but there's always these taxes in Europe, because Europe is the best playground for these kind of things, because there are different countries with different tax jurisdictions. And Apple in 2016 was fined $14.3 billion, I think, in back taxes to Ireland. They allowed them to pay significant, or they gave them kind of incentives and allowed them to pay lower taxes than other companies operating in the EU. Same thing for Google, right? In 2018, French Competition Authority fined Google 1.2 billion euros for using complex tax structure to avoid paying taxes. So Italy, the same. These are, so you need to be careful with these things because eventually they can come back at you. But I think companies think that they tried, if they get away with it, they get away with it, because some companies get away with it, even if they're sued, and sometimes they win that lawsuit, and it's worth it in these figures that we're talking about.
How does this apply for small business owners that might be listening about understanding and applying the accounting equation to their day-to-day ops?
For a small business owners, it's just as important. I mean, of course, it's not so much as Google and Apple can use it to reduce taxes, but I think it's very important making informed financial decisions. It enables them to make decisions about investments, their expenses, their financing. It's also crucial for better planning future expenses or anticipating financial needs. When you set realistic financial, you can set realistic financial goals. I think also the cash flow management, you can have a grasp of how understanding the impact of customer payments versus liabilities, supplier payments. So that kind of plays on working capital. I think I'm getting a little bit more technical. I'm trying not to be technical for those people that don't understand the accounting equation. The same way large companies can use the accounting equation, the small companies can also use that, from operational efficiency to strategic growth to financial reporting and valuation. So all of them, there's no difference. That's why it's important for small business owners not just keep their book balance, but also understand what it means. I'm not asking, small business owners and entrepreneurs to jump into the role of an accounting person or take the role of an accountant, but for them to understand accounting principles and use that in their financial decisions. That is essential for every entrepreneur to master. That's what I'm trying to, say here.
Now, regarding assets and liabilities and equity, could you sort of expand on this and how these can be relevant to a company's valuation?
The fundamental of I think this episode is to use the accounting principles, accounting equation, ultimately to convert those and understand the company valuation. And we will have episodes on that, which is called the free cash flow model. The accounting equation itself, assets equals liabilities plus equity, is the foundation of a company's balance sheet, as we mentioned earlier. So it's not directly used in the valuation. It underpins how a company's capital structure influences its value. And the way to do that is through one thing, and there's a good book for that written by McKinsey. The title is Valuation. It talks about the net profit less adjusted taxes. That's the NOPLAT, which is a key input into many valuation methodologies. It represents the after-tax cash flow generated from operations that are able to pay capital providers. NOPLAT excludes non-operating incomes and expenses on the P&L. In terms of financial valuation, I think some of the ratios that the accounting equation helps us establish are, for example, return on invested capital. And that is basically NOPLAT, the net operating profit less adjusted taxes over invested capital, right? It measures how efficient a company generates cash flow relative to the capital deployed. Higher ROICs, or return on invested capital, allows faster value growth. Another one is revenue growth. Growth in annual revenue over time, faster growth increases NOPLAT and cash flows, but only if the ROICs are added. And then you have also in the company valuations is what we call PE ratios, or price to earnings. That reflects the growth and ROIC combined. Okay, higher growth and ROIC have higher PEs, and these are used in benchmarking. And so when you look at valuations and you look, for example, in value investing, you look a lot at the price to earning ratios, and that's something that is used a lot for value investors. As that ratio is under 10, if you have a catalyst, whatnot, that company has a higher intrinsic value potential to appreciate over time. And lastly is in the free cash flow payout. I know I'm getting technical here. The point I'm trying to make with this is that you need to understand the accounting principles, the accounting equation, in order to be able to get to the more advanced stuff that is about valuation of your company. Because if you're an entrepreneur, or if you're starting up a company, or even if you have a company already running and you're looking to sell it, if you don't understand these and you only rely on advisors to tell you about these things, this will be gibberish to you. Imagine that happening. That kind of happened to me when I transitioned from the corporate world, where I was an engineer, into consulting, and I did my MBA, actually. That was one of the things that I learned is finance. To me, was a revelation. I mean, how much finance is fundamental to managing a business. You can't really manage a business without understanding fundamental accounting and financial principles. And all of these, everything you do ultimately translate to all these numbers that you see in the accounting. And these accounting numbers, you kind of restructure them to give you these ratios that kind of help establish the value for a company. So if you don't understand that relationship, you won't know how your work will impact the value. And that's fundamental.
Interesting. Yeah, it sounds like there's a lot of things that can come from really understanding the proper value, or how your company is valuated, including the way a bank might look at you when they're considering giving you a loan, et cetera, et cetera, et cetera. One area I'm interested in is, how does an investor funding or withdrawing profits impact that accounting equation, and what should businesses be mindful of?
That's one of the things that I've talked about also in other episodes. If you're a company and you're generating a profit and you're generating cash, probably that means that you're probably doing something wrong on the strategy front. You're not innovating enough, or you're not investing, or you don't have enough areas where you can invest that cash. And that's, by the way, you find that in largest companies. Like if you look at Google, Microsoft, Apple, if you combine, These companies are hoarding about $500 billion in cash, right now. That money they're using, basically they're earning interest 4% plus other treasury investments they have. They may be getting 7 or 8% on their returns on that. That's the return they can get from safe investments that they have in their treasuries. But realistically speaking, as a company, they should be investing that money in their core business or distributing that as dividend, unless they're keeping it for doing acquisitions, which is not really the case, right? I mean, because that money is there and has been accumulating and growing and not decreasing in size, with the exception maybe of Microsoft. Ultimately, I think as a business owner, the money that you make after you've paid yourself and your employees, and if you pay yourself partially in cash and partially in equity, the cash that you make shouldn't really remain in the company unless it's for, a rainy day. So like small business, you need to have some cash reserves, but having extra cash, kind of like the examples I mentioned, $500 billion for those large corporations, it's a lot of money to hoard and not invest in profitable or in their area of business and expertise. What that really says, you don't have enough opportunities to invest, or you're not doing enough optionalities. You don't have enough options or experiments in your business to diversify, ensure your long-term sustainability. That's, I think, would be the mistake, and basically distributing dividends, not to mention the tax implications.
Now, when it comes to keeping in mind this idea of the accounting equation, what kind of challenges does that create in the face of the digital world?
I think in the new digital era, you got both new challenges and opportunities, right? In terms of opportunities, I think we have where automation of accounting processes is now a feasible thing. So you have digital tools and softwares. You don't have to do these double entries anymore, all that kind of stuff. You can do real-time financial analysis. A lot of these things that you had to do, manually in the past, and request reports and ask your accountant or your finance person to do that for you. You can get it done automatically from the system. You have better accuracy. You also have more reliability of data and better accuracy and consistency. There are lots of opportunities as a result of that. But challenges that I think are facing companies today is the cybersecurity risks, the complexity of digital financial instruments, like the rise of cryptocurrencies and digital assets, for example, right? Companies must adapt their accounting equations to accommodate for these new type of assets and liabilities if they include in their portfolio of investments. Regulatory compliance issues. You got more dependency on technology, relying on tools. But all that aside, I think it doesn't mean that you shouldn't understand the accounting principles, because you need to understand the accounting principles still, even if the system can spit it out for you and tell you and give you insight and intelligence. If you don't understand the rationale and the theory behind it, it won't make sense to you.
Well, then I guess if we could wrap things up, maybe just get a quick summary of some key takeaways that you believe are important for the listeners to remember in regards to the accounting equation. We can start to close things out here.
I think the financial skills, accounting know-how, financial skills, but accounting know-how is essential for every entrepreneur and manager or leader in the business. These do require understanding. So the financial skills do require understanding of the accounting basics, because you want to take these accounting numbers and convert them into financial ratios and numbers that will make sense, and you can draw intelligence out. Never rely purely on your accountants or financial department for expertise. I didn't say bring them on as experts. Don't rely on them making recommendations or, expert recommendations, because you always need to add your thoughts to that. And in order to be able to do that, you need to understand these principles. As a business owner, entrepreneur, or manager, I believe that's a key responsibility to brush up on these skills. There are many ways you could learn this stuff, online courses or books or whatever, but this is essential for every business professional out there.
I suppose this wraps up our conversation for today. Very grateful again to have all of you business model hackers here with us, chugging away at the development and the breakdown of these concepts. As always, we go far more in depth on these concepts at businessmodelhackers.com. So be sure that you are subscribed so that you can get access to those resources that are far deeper in terms of its review, its breakdown, and summarization. With that said, we do also hope that you're supporting the social channels that we have available, where we're distributing some teasers of what we've got here on this podcast. It really helps the community grow and sustains it so that we can continue to do this good work for you. That being said, as you know, Sam and I thank you, and we'll see you in the next one.